Hi, this is Jeffrey Cohen, U.S. Advanced Computing Infrastructures Incorporated. We're a registered investment advisor in Illinois, financial planning, investment management, portfolio optimization. We also do quant analysis and data analytics for clients. So, what do we see today? We want to talk about risk off. Today was a risk off day, and you might ask, well, what does that mean? And why do you kind of get that way, right? Like, what's the point? So I'm going to show you some stuff out of our run, out of our data analytics run. This is from last night that you might see. Well, the first thing you might notice is the S&P 500 variance is this small number, 0.00023. So the way you read that is, because it's been pretty consistent for a long time, this is the daily price variance for the past year. And it's 2.3 times 10 to the negative 4, which is very consistent with where it's really been since about November. So we've plateaued to a point of variance. So, okay. The second thing you might notice is stocks are down. The QQQ is down 26%, excluding dividends, so maybe it's down 25%. The Russell's down 14%. The S&P 500 is down 15.5%. Again, less dividends, so maybe it's down 14%. And we're using a floor rate of expected return of 9.51%. That says we'll do about 8.1% return and 1.41% or 1.4% dividend. Net expected market return is 5.01%. So the expected return to risk assets when taking away the risk-free return is 5%. Okay, so I'm going to earn 5% if I put my money in stocks versus if I put it in some risk-free asset. It's not a lot of money, right? It means I'm going to make like 10%, but I get 5%, rough speaking, in bonds. In short-term U.S. Treasury securities. So that's not a lot. So that's my expected return. You see my risk-free rate's 4.5. So that has to pay for the variance that you suffer when you take risk on. So what did that do? So the first thing I'll just show you what it actually did. So we run different... we have different proprietary models that we look at, different proprietary sets of stocks. And we have one that has the highest betas, stocks with the highest betas, or the most systematic risk against the S&P 500. And that beta would be 2.8. And that says it's 2.8 times more risky systematically than the S&P 500. And if you look at those stocks today, you see one of them's up like 0.3. The median is down about 6%, and at worst, it's down like 13%. This is a terrible day for risk. If you own these stocks because you wanted to ride the wave of making money, you'd be losing your shirt. To lose 6% in a day is terrible. Hope you can hear that better now. What about the low beta stocks? So low beta stocks looking pretty good. Actually, you could see the change. Let's see if we can get that to come right. You see more than half the stocks are green. The largest decline is like minus 3.4%, but most of them have fallen less than 1%, and you can see some nice gains here. So low beta stocks, which don't really move when the market moves, they have less systematic risk than the rest of the market. They're doing great. Making money. Love it. On a bad day today, S&P 500 is down 0.83, and yet you're making money today if you were investing in risk-off stocks. So that's the simplest way to measure it. There's some other ways to measure it. You can look at platykurtic versus leptokurtic stocks. So platykurtic and low variance stocks are ones that have a lot less risk of surprise. Let's see how they're doing. Leptokurtic stocks with low variance, holy cow. There's 72 of them, and they're mostly lower. So that's 72 stocks that are low variance, lower risk, that are down. Now, if we look at higher risk leptokurtic with low variance. And you see that they're also down, but they're down more. And then there's some that are up. But the ups are like mostly less than 0.6%. And MO, Altria, cigarette company, is up 1.5%. But that's a lot of them that are down. And at the top, it's also the Allstate is down almost 7%. So the stocks that can surprise are being punished a little bit. So risk off. So if I look at certain industries, right? So money managers like it when the market goes up. They like risk, market risk that pays off. And you look, Schwab's down 7% today. KKR, Credit Suisse First Boston, Blackstone. So every single stock that traded, these don't trade anymore, are down. So money managers are down. How about semiconductors? Chips and semiconductors. Those guys have been the crazy risk magnets of this market last year. And you can see down pretty aggressively, all of them down. So it's a risk-off day. When you look at the market, you should be thinking, okay, it's a risk-off day. The S&P 500 is down. The NASDAQ is down. The Russell's down. My guess is if I go to Cohen and I look at just the market today. No, I don't want to do it that way. I want to do it this way. Morning look. Cohen top page. I like Cohen. You're going to see actually that the market for 5 days, it's dropping. It's dropping. You know, it was up 2% and now it's down 1%. It was flat. Now it's down almost 3%. You can see small cap growth stocks are down more. But what's interesting is large value is down more than large growth. So large value, mid value, small growth. But truthfully, it's just risk. So energy's up, which makes sense. You know, oil's up. Communications is usually a bet against interest rates. And then for the most part, consumer discretionary is down, almost like it's some kind of a recession bet. Industrials are lower. Financials are lower, I think, because short-term interest rates have gone up. You can earn almost 5.5% risk-free right now. And so banks realize they're going to have to pay 4.5% risk-free. But what are you getting when you lend long on risk-free assets? You're getting 3.5%. So you're losing 1% of net income. Net interest income of minus 1% if you borrow short and you lend long. Now, of course, you could lend to companies like those industrial companies, like discretionaries, like technology companies, but their stocks are falling, their businesses are falling. And so why would you want to do that? It's interesting. So what else does it tell me about risk off, or are we just going to wrap this thing up? Let's go back and see. So the first thing is your high beta stocks. One of them's up. The rest are down. And actually, they're down quite a fair bit. The median looks like it's down almost 6%. Your low beta stocks, which is a risk-off day, a lot of green. Now, not all of it, but almost every low-risk, low-beta stock is up. Okay, so Jeffrey, you have a stock model. Your U.S. advanced computing infrastructure using all this advanced technology and advanced computing and algorithms and data. Well, why is it risk off? Why did you think it would be risk off when you ran your model? Well, I already told you about the initial parameters, which is, yeah, the market's probably not worth, going long. It's not worth it, right? But now let's take a look. So the other thing you see is that there's actually no stocks that score individually better than the S&P 500. So if you're a retail investor and you don't have time for any of this, just get an S&P 500 index fund. Go to Vanguard, Fidelity, any of the guys. At low cost, low risk, passive fund. If you like to own stocks, you really want to own stocks, SPY is an ETF. And SPY is trading at 388.19. It pays a dividend just like the S&P 500. No problem. You're in. Just because there's no one stock that's better. Every stock is worse. But now let's take a look at the answer, right? And you see 388.27. This thing was just about 400 not long ago. It's actually been falling this week, as you saw with Cohen. So let's take, and these are a lot of different runs. Let's take a look. What's the best answer? The best Chicago Quantum Net Score portfolio is 52 ticks better. So remember how we said the variance was 2.3 times 10 to the negative 4? This is 5.2 times 10 to the negative 5. It's a very small edge in the market. And you have to buy 20 stocks and hold them evenly to get that edge. See if I can make this bigger and show it to you so you can get a feel for what those stocks are. And many of those, I know the names by heart, and so we can talk about them. Those are all the different solutions that we're running. And we have things like leptokurtic, platykurtic. We have skew, positive, negative skew. We have volume up, volume down, price up, price down. Dividends are high, doesn't pay a dividend. We have all these different ways to look at stocks. But this portfolio right here is the best portfolio found based on last night market close. So, of course, you got to own a little Apple, a little Microsoft, a little Advanced Micro Devices, a little Amazon, a little NVIDIA, a little Qualcomm, Rocket Mortgage or Rocket Lending, Blackstone, the Carlyle Group. UEC is a uranium company. IVZ is Invesco. They're the company that actually sponsors the QQQ, which is the NASDAQ composite. STT, State Street. SYNA, Synapsis, Intuit. Some of these I won't remember and I don't want to get it wrong. So Melli, which is Mercado Libre, which is an e-commerce company. And so you hold them all. And so what happens is, if the market drops, they're still going to drop, but maybe not quite as much. And then you hedge it against the S&P 500 for the exact beta that these stocks have. And that's a way to make money. It's a hard way to make money to manage 20 different positions and a short position on the S&P 500 to hedge. It's just fascinating. Now, that to me is risk off, because risk off is saying, all right, 5% in 20 stocks. You're still going to hedge it. What happens if I do this against the QQQ? Now, here's where... So it's interesting. So when you do it against the S&P 500, because the S&P 500 is so efficient that you're at this place where you have to have 20 stocks to beat the S&P 500. It's a good reason. If you're a retail investor, just hold the S&P 500 and put the rest of the money in a short-term risk-free debt. So I'll show you that. There was a question today. Hey, Jeff, what should a retail investor do? How much should a retail investor pay for a financial plan, and how should they invest their money? They were really more focused on how much they should pay to have a financial plan made. And what I said is, I got a free website. Just search for Myron. So Myron's a real guy. I met him, we had a real story, and he gave me permission to write the story down. So I'm more like a storyteller, right? This was a potential retail investor that we met for coffee while I was interviewing for a job, and I'm like, I don't want your money. I'm just going to tell you a story and how maybe you should think about investing. Can I get some good tips for free? What should a little guy like me invest in? He has about $25,000 that he can put in the market. So what I suggested for him was the first 10 grand, go to treasury.gov, treasurydirect.gov, government website, and buy I-Series U.S. savings bonds. You're going to earn, at the time, it was 9.6%. Now it's 6.89%. It's awesome. Now what I might say is, look, if you need the money right away, put it in, go to treasurydirect.gov and do a non-competitive offer for 13-week or 26-week or 1 year money, debt. Give the government your money for 13 weeks to a year, and they're going to give you between 4.5% and 5% interest. Oh my God, 4.5% to 5% interest. No risk. It's free. All free. Great. Now the next $15,000 goes into a low-cost, passive index equity mutual fund. We like ones that track the S&P 500 because it's so efficient. But there are others who prefer NASDAQ or the Russell 2000, and that's fine. We personally use Vanguard and Fidelity, and either one's great. Point is, you just invested your 25 grand. Now you work in a T-Mobile for a year. Maybe you save another 25 grand. What do? You take your next 10 grand and you put it into U.S. savings bonds or put it into treasuries. And another 15 grand goes into U.S. equities, and you watch your money grow. Do this for 20 years. You're a millionaire. It's no problem. You love life. Now, if it's more risky, if the market bottoms and you want to take more risk, maybe some of those years you don't put any money into savings bonds, or just 5 grand, and you put 20 grand into stocks. Next thing you know, you're getting rich even faster. And the point is, stocks go up and down. And so you're just investing during up times, down times. The worst thing you could do is stop investing when the market goes down. If you're earning and you have savings, you want to invest it when the market goes down because you're buying low. Maybe when you go to retire 20 years from now, you're selling high. Love and life. So that's the story. So let's take a look at this QQQ. This analysis we did against NASDAQ. So the first thing to notice, again, we're risk off. This video is about being risk off, and yet we run our model sometimes against a more risky index, against the QQQ. And we didn't used to do this. So I know I have an old client out there who's probably watching. This was a new innovation. So the variance of the QQQ is actually 4.1 times 10 to the negative 4. It's much higher. So from 2.3, what was it? Come on now. 2.3 to 4.1, significantly higher risk for the QQQ. Okay. You still get your expected market return at 5%, but now you're running against an index that's much more aggressive. So what stocks does this model pick? Talk to me, Jeffrey. Where is my best pick? And what you're going to find is going to blow your head off. The best pick is 36 stocks. So if you're a believer in NASDAQ, you want to divide it up and put roughly 3% in 36 stocks. That's crazy. That's a lot of work. But you're picking different ones. You're picking gold. AAAU. Now, never a bad idea to put 3% in gold. Love it. TLT, which is a long-term treasury. SHY, which is a short-term treasury. Okay, so I got some gold. I got some debt. I got Broadcom. I got Activision. I got Kimberly-Clark. I got Johnson & Johnson. I got Google. It's a who's who of different companies. I have P&M, which is a regulated utility out of New Mexico, and I got Tesla. I got USO, which is oil, and I think that's Texas Instrument, Dryden Restaurants, Microsoft, Merck, LPG, which is an energy company. So you get a feel for what this is saying is, if you're more of a risky tech investor and you want to play today, you got to have 36 stocks. That's risk off. Just telling you, right? It doesn't say every stock is less risky. You got some risky in there. You got Tesla. You got Microsoft. But you also have Merck and Johnson & Johnson and Kimberly-Clark. You have low risk mixed in. You have oil. You have bonds. You have short-term debt. You have gold.
You have the least risky stock in the entire United States, PNM Resources. This is interesting. And for the same edge, you can have 2.5% in 40 stocks. And now you add Walmart. I mean, it's interesting, right? So 40 stocks, low risk, risk off. You do this, you're going to sleep at night. You're going to sleep great. By the way, you're also hedging against declines in the S&P 500. So, yeah, that's what risk off looks and smells like. When the model's risk on, it picks like 4 stocks. You put your money in like 4 or 5 stocks and you're like rolling the dice and you love it because you can make big money then. It's hard to make big money when you're holding 36 stocks, right? That's like a mutual fund. So I just want to share this with you. This is what risk off looks like. This is what we've seen this week. Because short-term debt is so, it's paying such a high yield, and equities really aren't promising right now. When you talk to people, they tell you that equities right now are expected to go down for the first half of the year, go up in the second half of the year. And I've had a lot of people say, you know what, Jeff, you're probably right. We're probably going to end up around 4250. Okay, S&P 500, 4250. You look at it over 5 years, you're not even making up the peak. You're basically making up here where you were in August. That's not a very aggressive play. If you thought, hey, the U.S. economy is doing great and I'm gonna make a ton of money and the whole economy is doing great and we're going to beat inflation and we're going to raise interest rates and oh my goodness, everything's awesome. Sure, you play a different world. You play it a different way. But for right now, this is what we see. We see a declining market. And so eventually it comes up to 4250. That's fine. That's not that crazy, right? And so maybe it goes to 4,200 because the market looks like it's down under 3,900 now. But you're kind of going up 300-400 points. So 42, 4,300. Plus you're getting your dividend, which is nice. If that's what you believe is going to happen, then our model is telling you what to do, the most perfect optimized portfolio. If you think the market's going to fall, you get out. Why would you have any stocks if you think the market's going to fall? You get out completely. You just hold debt. If you think the market's going to go up, let's say 20%, it's going to really recover. We're going to take back 4,600. Then you need to buy fewer stocks and more risky stocks. But right now the market's saying nope. More stocks, less risk. Rock and roll. So I want to thank you for watching. That's risk off. That's where we are today. And we're just going to quickly double check to make sure that we're still risk off. Because what happens is the market seems to turn on a dime these days. So if we look at risk off right now, risk on right now is all money losers. 5, 6, 10 stocks between 5 and 6. So you're at a 5.5% median loss for today. On low risk, low systematic risk, without real any judgment, you have 2, 4, 6, 8, 10, 12, 14, 16, 18, 19 stocks. 13 are up or flat. We'll go between 9 and 10 here. Yeah, your median gain is 0.25%, like 0.3, 0.28. So not bad though. When the market is down almost a full percent, you're out earning the market if you were risk off today. And so I want to thank you for watching. I'm Jeffrey Cohen. If you liked the video, please hit the subscribe button, say you like it, drop a comment, maybe go out on Twitter, Facebook, LinkedIn, whatever, and tell people you liked it so they can watch it. It helps us. We don't make money making the videos. What we want to do is share our expertise. so that you can go and you can click on our website, chicagoquantum.com, go to advisory services, and see how it is that we serve clients. All these different services. Maybe you could check out our brochure, which, by the way, we're updating right now. But here it is. And you can see how we help clients. Love to help you. Love to get some new clients. This is what we do. We do financial planning services. And so thank you very much for watching. You take care now. Bye-bye.